The banks are crashing in the United States, and it's about to get much worse. Big trouble is ahead for many banks that have commercial real estate in their portfolios. Fed Chief Jerome Powell warning, quote, there will be bank failures at the Senate Banking Committee that was in early March due to declining values and defaulting loans in the commercial real estate space. Smaller banks are specifically feeling the pinch. Specifically, those small and mid-sized banks could collapse in the coming months. And guess what? The consolidation will happen. They will be either failed completely or gobbled up by the bigger banks. That's exactly what they want. It's all part of the plan. Listen to what he said in March.
On commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made loans to many of those buildings. Not all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them. And so for some time we've been doing that. And, this is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks. If you look at the very big banks, it's not a first-order issue for any of the very large banks. It's more, smaller and medium-sized banks that have these issues.
It's worth noting that we heard a similar message from Janet Yellen, U.S. Treasury Secretary, just a month earlier. Yellen told lawmakers that bank regulators are working on addressing risks tied to high vacancy rates and lower valuations across major U.S. cities. And it's no secret that the commercial real estate sector has seen huge impacts since the pandemic. The work-from-home revolution has brought about sweeping changes for society and for the economy at large. Who wants to go to an office building, commute 2 hours? Office spaces and retail locations, specifically in these areas, have been absolutely crushed, where they have high vacancies, and we've seen this massive turnover over the past few years. Who wants to open a business and move individuals into an office space anymore? There's no sign of things trending in a positive direction in that regard. I picture sort of like the Mad Men era of New York City, right? The 1950s, everyone taking the subway to go into New York City to work in the high-rise building. Really? Most buildings now experiencing 20-30% vacancy rates. You don't have to be an economist to see that things have gone south. If you've been in any downtown area or shopping mall in the past couple of years, it's blatantly clear that there's been a shift in commercial real estate. Everything is moving online and out of the big cities. In fact, Moody's analytics found that a staggering 19% of office spaces were not leased in the fourth quarter of 2023. That's up from 18% back in 2022, and it keeps going up. This major shift in the workplace has totally upended the commercial office space industry. And if you combine that then with higher interest rates, it's put pressure on these leaseholders and lenders alike, resulting in many businesses defaulting on these loans. Why are they going to refinance into a higher interest rate for a building that's half vacant? It doesn't make sense. The math doesn't add up. Nearly $1.5 trillion of U.S. commercial real estate will be due for repayment by the end of 2025. Do you hear what I'm telling you? We are sitting on a ticking time bomb. And with interest rates being a bit higher, refinancing is absolutely risky right now. Banks like Chase and Wells Fargo will walk away from the fallout largely unaffected. In fact, they may even profit by having a larger monopoly in the banking industry going forward. Their exposure is lessened. They'll be able to come in and gobble up all of these smaller banks. So these smaller community banks, these regional banks, they don't have much capital to fall back on. The future is bleak. So they will reach out for a lifeline from the bigger banks. Game over for them. These small local banks with a high percentage of commercial properties on their balance sheets will fail. That's exactly what Jerome Powell said. There will be defaults and collapses in community banks. We heard it straight from the horse's mouth. You don't have to read between the lines. There's big trouble here. In fact, the Federal Reserve's own data from September 23 shows that commercial real estate comprised 44% of portfolios at these small banks. Wow. Only 14% of the country's big 25 banks had any commercial real estate exposure. This situation could have serious consequences on a widespread scale. If you have money right now sitting in small or local regional banks, start thinking about ways to protect your money. There's no longer any uncertainty about how work from home practices and the changing economy will affect office spaces. We're seeing it unfold right in front of us. Things are crashing. Now you might think, so what? I'm not a bank or a commercial real estate investor. But the truth is, when the entire systems like this collapse, the downstream effects are widespread. I mean, I just gave you one example, right? Just think about the retail spaces and the businesses that are the spillover from these offices, where people go to lunch on their lunch breaks and then have a coffee, or go to the post office or do different things for to mail a package. Well, when there's no one mailing packages, there's no one having lunch. Guess what happens to those businesses? So layoffs and businesses closing. The banks right now are failing, and cities which are already feeling the strain of a growing homeless population, an influx of illegal aliens, and transit issues, just to name a few, are now seeing commercial real estate and banks failing, and their tax base is crumbling. And since the Biden administration had wanted to largely defund the police forces in many of these major cities, and there was a big push for that in a lot of these liberal cities, so now you have high crime as well. So the overall health of our cities is massively on the decline, and it's not looking up from here. So now more than ever, it's important to protect yourself and your family's future. Let me give you some specifics on that. If you have large amounts of cash sitting in bank accounts, consider how you can diversify that money. It's totally up to you. If you want to run the risk of a bank run and keeping your money in these banks, good for you. That's totally on you. But I could do a whole other video on that specifically. But off the top of my head, you could be buying gold, real estate notes, rental properties. You could invest in retirement accounts. You could be moving some of that cash that's in these small local banks, again, and buying gold and having it stored off-site or on-site in your own gun safe, for crying out loud. At the very least, please make sure you don't have more money in the bank than is covered by FDIC insurance, $250,000, okay? FDIC will cover up to $250,000. But as I've pointed out here on the channel, that's, at one-off banks. This bank goes down, we can take care of those individuals. But what if all of them collapse? How is the FDIC going to cover all of it? The answer is they can't, and they've admitted as much. As we've covered here on the channel, and we showed you their private meeting notes and their private meeting discussions on video, where they openly admit that they can't cover it all. And they don't want these massive bank runs, so they're going to try to keep it quiet from you and not tell you about it. So if we go over that threshold, we go over that $250,000 limit, it's a quick way to get burned if your bank collapses, because they can say, well, we told you we'd promise you up to $250,000. Sorry, you had more than that in there. That's gone. So if you need to diversify, consider having accounts at different banks to minimize risks. You may even have been taught that the bank is the safest place to keep your money, but clearly that's not always the case. After the collapse of Silicon Bank in 2023, the idea of bank failures is not just a conspiracy theory, it's a very real possibility in this economy. As always, the most important thing for you to do is educate yourself financially. That's why I want you to watch this next video on the state of the credit card debt in the United States. Click here to watch that video right now. We'll see you next time.